is so what has come to pass is basically the regulator of porn is the credit card companies, and nobody knows this. And we're back. Pirates of Finance is back. We're, I think, what are we at the end of this last trading day of the month? So that's always exciting. Turn of the month is always a really hectic process for both you and I. But I want to actually, now that we're back, I want to do a bit of a sentiment check with you. So you've been living in the Cayman Islands and you've traveled very little when you were living there, which was very smart of you. But now you're back stateside, and part of that means travel. So I want to do a sentiment check of where we're at as far as reopening. You're traveling to conferences, you're traveling to meetings now. What's the sentiment check with Corey Hofstein on travel these days?
Yeah, anyone who says that business travel is back is a goddamn liar because business travel is horrible, and I think we're going to avoid it at all costs. I just took a trip to Raleigh, North Carolina. I flew in from Boston to Raleigh, had someone flying in from Toronto to Raleigh, and had a coworker flying in from Denver to Raleigh. I was the only one who made it in on time. The other two were delayed by several hours. And then on the flight out, we were all leaving at the same time. Two of us were delayed. One was delayed 2 hours. I was delayed, I think, 6 hours getting home. I think I was supposed to get home at like 7:30, and I think I got home, I don't know, 1:30 a.m. was by the time I finally got into bed. So if I don't seem bright and perky today, Jason, it's because we're on some low sleep. But we're gonna try to keep the energy levels high here.
Yeah. No excuses, no excuses. And then I
That's right.
remember like your previous trip, you were texting me about being on the tarmac for like 4 to 8 hours or something ridiculous and getting rerouted through Philly. But
Oh yeah.
does it also go through your mind as well as like the old Louis C.K. clip? And then what happened? Did you fly through the air like on a magic carpet ride? Like everything's amazing and nobody's happy. So it's a weird like you want to complain, but at the same time you're like, first world problems.
Yeah, I mean, it definitely makes me rethink. Like, there's nothing that replaces a good in person meeting. When you can sit down with someone and really have a great conversation for an hour, it's hard to replace that with something like Zoom. It just really is. There's something magical about being in person. But I will say, pre pandemic, going from I would jump on a plane for anything to now post pandemic, where a lot of people who were anti Zoom have now been trained to use things like Zoom, I am way less willing to travel. It's just the way airports are right now are disaster. If I can take the train, I'd rather take the train. If I can drive, I'm certainly going to drive. Flights are still amazing. Don't get me wrong. I feel like every time I go through an airport, it's this going through TSA. I think humanity is the grossest, worst thing. And then as the plane is taking off, I'm like, we are the most unbelievable creatures. We have conquered flight. There's nothing we can't do. And then we land again and it's baggage claim, and I'm like, we are just gross and horrible. So it's a mix of emotions. I don't know. You fly a lot. Like
Do
you
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 have
you flew a ton
yeah.
during COVID. Like you were moving all around the country. What's been
Hey,
your
let's calm
experience?
down. Let's calm down. I flew safely during COVID and things
I
like
didn't say
that,
it
but
wasn't safe.
I
I
know
didn't
I
say you were
always
a super spreader.
yeah. I've had actually great experiences. I think I've been very lucky for the most part. The other question I was going to ask you, I don't know at Logan if you guys have clear, but I have global entry, TSA pre, and clear. And then the other thing that people don't know about like SFO is I think there's only like four airports in the country that have private TSA, and SFO is one of them. And so you get like this amazing like speedy trip, even if you don't have clear TSA pre. SFO is usually one of the better airports to kind of go through because of that private TSA.
I've never even
But
heard of
to me,
private
like
TSA.
clear and those yeah, there's only like four airports that apparently have it. So it's still under the TSA and everything, but it's run as like a private enterprise that's like, uh, you know, farmed out from the TSA. So that's why you have a different experience at SFO allegedly. The other thing is like having clear to me is a game changer. So rarely do you really need TSA pre or clear, especially at SFO. But the times when you do need it is that long tail, right? And it is a lifesaver to kind of have clear. And what's always shocking to me is like you feel so bad and so good when you have clear, right? Like I think it's like I want to say as a couple or something, it's maybe like 150 bucks a year, and they just take you right up to the front of the line, open the gate, walk you through right to the front of the line, and so you're cutting ahead of all these people that are waiting in line for like 30 minutes. So you feel kind of like a douche, but at the same time, you're like, dude, you could pay $150 and do the same thing. So I don't know what to do, but it's saved me, several times when TSA has been incredibly backed up, and not so much at SFO, but at other airports.
Listen, it makes complete sense if you fly a lot and you're at an airport with Clear. When I lived in LA, LAX had Clear. My wife used it all the time. I would go through TSA pre-check. I mean, TSA pre saved my bacon flying out of Logan this time. I was flying JetBlue, and the line for TSA must have been 200 people, and there was legitimately 7 people in line in pre-check. So it tells you something about who's flying right now and what's getting backed up. It's like the regulars who fly who have pre-check are not, maybe the volume isn't there for business travel the way it used to be. But you're absolutely right. If you live in an airport with Clear and you travel more than once a month, I mean, that sort of thing pays for itself in time alone. Because you spread it out across the cost of all your flights, and it's not that much more expensive per flight if you're flying enough.
Yeah, it's just frustrating when you're at an airport that doesn't have Clear and
Yes.
has a long TSA line, and maybe sometimes, especially when I'm in Philly a lot, it's like they even shut down the TSA pre at most of them too, and it's like they give you a card to go through. But enough of those complaints. Have you followed? I haven't been close, so this is just totally random on the blue because you just talked about like JetBlue and everything. Do you see like JetBlue is allegedly buying Spirit? I don't know if
Oh, I didn't even
this
see
deal's gonna
that.
close, but it's been yeah, so I think Spirit was trying to acquire Frontier, didn't work out, and then JetBlue came over the top, and I think is trying to buy Spirit. I don't know how
I
much
feel
that
like
would
those
change
could
Spirit
not be
Airlines, but I know
more
it's more of an East
opposite
Coast thing.
airlines, right? Like
Exactly. That's why I was like,
JetBlue could not be
I was
more
trying to
about like
understand it.
the luxury experience for the everyman. They talk about having the most space in economy, it's nice new planes, and then you take Spirit, and it's like being a sardine, right? You just packed in there. I'm kind of surprised. It'll be interesting to see whether it's just for the routes. Like, I wonder if there's certain hubs that JetBlue is just looking to get access to, and they can take over the routes from Spirit and replace all those planes. But that said, there's something like I don't particularly want to fly Spirit, but I know there's a lot of people who aren't of the same economic means for whom a low cost, very economical airline makes a lot of sense, right? And they're willing to use it. So I would hope that JetBlue doesn't necessarily just get rid of it, or it does open up the market for an entrant, a lower price entrant.
Yeah, I don't mind. I actually don't mind Spirit at all. Like to me, it's like you get what you pay for. So if like I've flown it a couple of times, especially when I'm on the East Coast, like West Palm Beach to Atlantic City, right? Like so, like you can get to that Jersey Shore faster or whatever, and it's cheap. You know what you're getting, so like I don't mind it at all. But I think you have, was it Go Breeze was started recently by the founder of JetBlue, and so now you have that new entrant. And they started a lot of like Southeast, and I think they're expanding across the country. And he's trying to replicate a lot of that. And like you said, you'd hate to see it go away. And that's you just like hit a pain point for me because on the West Coast, we're very like Alaska Airlines centric for a lot of the
Yes.
routes and hubs. And Alaska Airlines bought Virgin America, which used to have great flights for us for Virgin America to South Florida, and then you get that quality of like JetBlue. And then Alaska just shut down Virgin America because they didn't want the competition.
Yeah.
So it's
So
been
I
like the bane of our existence like during COVID.
I was like a Virgin America premium flyer because I flew from Boston to LA, and that was like the best route was Virgin America. And then when Alaska bought them, I became an Alaska premium tier member. All the points sort of rolled
Yeah.
over. It was great because then I was living in LA, and they had a bunch of West Coast flights, and they had Alaska, LA to Boston, and then COVID hits, and all of the flights disappear. Right, their main hub is I think Seattle, so they still the spokes coming out of Seattle. My family's all
Yep.
East Coast, so none of those flights mattered. So I went from like ultra high tier Alaska to my points now that I'm back living on the East Coast are meaningless. And it's like all this time wasted in dedication to an airline that I'm just watching my points slowly disappear over time. And I'm like, I don't know. I don't know how to describe it. It's a really painful feeling to watch a numerical accumulation of your time slowly waste away and be meaningless. I used to think points were
Yeah,
amazing.
it's
I
almost like
really,
that.
I like what. Talk to me about your feeling. Like I used to think points were like everything, and now I'm almost disgusted that I have status on an airline because it's like I don't want to be flying.
Well, that's based on your two most recent trips, most likely. But I'm almost with you in like it was remind me of the there's an old like a older maybe a decade ago Justin Timberlake had a movie. It was called like In Time or just like Time or something like that, where it's like you had on your forearm the amount of time until you died, and it was like so it's almost like the expiring. The points with your airline is almost very similar. It's like I only have the rest of the year to use these, and it's
Yes.
incredibly frustrating. But at the same time, and so with you, I feel almost the same way. And way back in the day, I used to travel hack, right? Like using all the points and getting, 15 credit cards, trying to combine the points, so then you can get free travel to Europe and South America and Asia. But it's really unwieldy, and it takes a lot of time to actually manage that process. But lately, we just kind of focused on American Airlines and just getting the status there. And then those, I got to admit, those random upgrades are pretty nice. So
Yeah.
maybe I'm not hating my points on American as much, but I hate to see, like you're saying, that dwindling, like gives you a sense of panic, and you're like, it's just airline miles.
Well, it is, but the problem is like I, for example, when you're going for the miles, like you typically get a credit card related to the airline, right? So I had been using
Yep.
like this Virgin America credit card that I had a whole bunch of points up on. Great. Now I really need to transition away from that because I don't need to keep getting points on Virgin America. But yeah, I never did the credit card hacking or like the travel hacking stuff. I always sort of was nervous about just accumulating a bunch of open credit cards, right? Because so much of that is like
Yeah.
opening these cards for points, and it's like, well, I'm not really sure whether I want to have 15 open credit cards in my name, you know?
Yeah, it's like keeping pints of ice cream in your house on stock. It's probably not the best
Right.
idea. Like as far as not having access to that credit. But a couple other things I want to touch on, just because I want to add some practical value almost to this, is like, well, one's absolutely ridiculous. When you guys were living in LA, did you ever see like like private waiting room that like the Kardashians and everybody use, where you pay a membership fee at LAX, where you can just
No.
and then they take you in SUVs right to your flight?
No, I was escorted with the commoners well away from that. No, I never saw that.
It was like, yeah, you pay like I want to say it's something, or it was like $50,000 a year or something like that. It was just like it's just, of course, only at LAX would you see something like that. But one I want to touch on that you and I think have talked about privately. I'm not sure if you used it when you were in LA. It's just become more frequent now. Is JSX. So on this West Coast, we have this amazing airline called JSX, and basically it uses these like 30-seat brand new Embraer planes, and it flies from FBOs, so the private airline airports. And so like we use the private airport here in Concord, which is in the East Bay, and then you fly down to Burbank, but you go to the private airport in Burbank when you go to LA. And if you get these tickets in advance, it's maybe $79 to $99 each way. If you get them last minute, sometimes they can be up to $299. But it's almost like the ability to fly private through these private FBOs, where like your timing's so much better. You could show up 10, 15 minutes before the flight and just walk right onto the plane. And it's just incredibly time saving. And they've expanded from, it used to just be LA to the Bay Area. Now they're starting to expand around the West Coast. They're going to Dallas flights now, and eventually they're moving to the East Coast. But it's
Hmm.
amazing how many people have turned on to like JSX, and like how it's a game changer. But now that you're on the East Coast, all you can do is cross your fingers that eventually it comes to the East Coast.
So one of the things I've thought about, I've never really looked up. I'm curious if you know this. Like these smaller private airlines that allow you to just walk on with really zero security clearance. Like how's that work from a federal regulation perspective? Like there's no TSA evaluating you when you just walk on these smaller flights. Do they just say flights below a certain size, we don't care if they get hijacked, or flights below a certain size, we don't, like how's that work?
Yeah, it's the trade-off. I think when, yeah, so there's got to be some loophole in that regulation there where if you're flying privately with like a private jet and everything, they just assume you're the one chartering it, so it's incumbent on you for your own security and who you bring aboard with you. But yeah,
Right.
you get into this liminal space, right, when you have these 30-seat planes that are working out of FBOs, and you walk through like a metal detector and stuff. But yeah, it's minimal security at best, and yeah, it does make me a little bit nervous every time. But there's got to be some sort of loophole if you operate out of FBO where you're just under the private aviation guidelines versus commercial aviation.
Interesting. Well, for those of you just tuning in, this is Pirates of Finance, where we talk about airlines. I guess that's what we do now. Well, let's
Well,
actually
I'm gonna
let's
be a
hit
well,
pause
what?
here because I just want to say, like you did mention, we're back. I'm going to treat this as if it's season 3. You know, season 1 was us putting together super high quality videos. Season 2, we were live and hosted on by Blockworks, and season 3, we're feeling out as we go. We're trying a new format here. So we're back and new, and I think the whole premise is we're just going to talk about whatever the hell we want to talk about, which will probably mostly be finance related, but it's going to be a lot of shooting the shit for sure.
Well, the one thing I actually love your breakdown of the different seasons, and we're in season 3, except I hate how words become like part of the zeitgeist and become en vogue. And it seems like a lot of stuff I've seen recently on YouTube is people talking about different seasons of their lives, and it's starting to drive me kind of crazy. So.
Well, listen, I've been doing seasons with my own personal podcast for 5 years now, so I'm not dropping it just because other people have co-opted my word.
Yeah, I don't mind your seasons for a show. It's when people just start talking about their life cycle, their own personal life cycle, or as seasons. That's what it bothers me. So
I like to think about my life cycle as a chapter storybook. What about you?
I don't think of it linearly. It's just these random dot plots that if I go back, I can draw some sort of Rorschach painting over it. But like it's just completely random. One of the things while we were gone and needed a little bit of a break, one of the things I wanted to talk to you about is this new Hot Money podcast. So I listen to the podcasts with Breaking the Rules with Michael Lewis, and that is produced by Pushkin Industries. And so they had a preview for this new podcast that Pushkin is co-producing with the Financial Times with FT called Hot Money, where these two reporters from the FT decided to explore the business of pornography and the modern like thumbnail industry and how it evolved. And there's so many fascinating things. I want to say they're up to maybe 9 or 10 episodes, so I'm not going to give any spoiler alerts or anything. But I just wanted to highlight. I want to pull out some of the highlights to talk to you about from the business sense that I thought were fascinating. So the series kind of starts off with this idea of Fabian Tillman had the idea of just doing a roll-up acquisition, right? And so it's classical roll-ups, whether it's waste management, et cetera. It's a good model for like building a conglomerate. And he had originally done, I think, a lot of like the ancillary kind of credit card servicing and stuff like that. So he got to understand the nuts and bolts of how these tube sites work. And he thought using his technology, he could run at a higher profit margin. And so he was running at like a 50% margin on some of like the tube sites that he owned and managed. And so he was searching out, how do I get some capital to go on an acquisition spree because I don't have much money. And he was talking to, hundreds of different banks, investment banks, not really getting anywhere until he linked up with Fuel Break Capital. And Fuel Break helps like these non-conforming kind of unique style loan structures and helps place those for their clients with like investment banks, et cetera. And even though he was having like 50% margins, because nobody wanted to touch the industry, Fuel Break was able to place about $100 million in loans for him at 20% interest. So he had like this just amazing interest that he had to pay. But what's interesting is once the $100 million loan got placed and he started putting it to work, the bankers came back to him and like, we love this, because obviously they love the 20% interest. They're like, give us your wish list. So he gave him the wish list of companies he wanted to acquire. They loaned him $360 million to go on a buying spree. And then because of his abilities on the back end with his 50% margins, everything, he was able to 4x revenue. So at one point he's doing $100 million a year in profit, right? But this is where always things start to get interesting, is his idea, or he says, at least in hindsight, his goal was actually to acquire all of these free tube sites. But eventually, once at one point, he's controlling 60 to 70% of the internet porn traffic, is that he wanted to then shut them all down and put it behind a paywall. So now he would charge, basically like everybody would just be in a hostage situation. And now they would have to pay him. And he felt like, this is all in hindsight and on a podcast, that he would kind of be the savior of the industry and make it profitable again. So, but while he's trying to do all this, he gets arrested in Germany for some just like random nefarious thing. Like it didn't make a lot of sense, right? So it's like, what's really going on here? So when he gets arrested in Germany, all the bankers decide to pull his loans because now he's getting arrested in Germany. And so when the bankers pull the loan, all of a sudden this guy comes out of nowhere that used to own RedTube, and he just happened to be a former Goldman Sachs employee. And so he's a super secretive person, and he ended up developing this company called MindGeek or ManWin, and this is how they create this acquisition. But even better, so the bankers pull the loans when Fabian gets arrested, and then those bankers turn around and offer the owner, this secretive owner of RedTube that used to be a Goldman Sachs employee, they offer him $500 million in loans to buy out Fabian. So they had loaned 360 million to. He gets arrested. They pull him, and they manage to turn around and give it to a former Goldman Sachs employee, a half a billion dollars worth of loans to buy out his company. So that was the interesting thing on trying to do the roll up acquisition, all this secretive and the banking side of it. But then there's also like these little things they went into like the history of how these sites started. And it starts even like the late 70s, early 80s with some Ohio libertarian hippies that own like a furniture store outside of Columbus. And they started one of the BBSs, which you were probably a kid on bulletin board networks. And part of that is they were libertarians and people want to start sending in like different, images or like, pornographic images. And initially they were like, a lot of people were sending in Playboy images. And this couple decided, we know Playboy will eventually come after us, so we have to moderate this. We can't allow these images on our site. But some still got through. So the irony was, because they were moderating and trying to keep those images off their site, Playboy sued them and said they're a publisher. And therefore, because they were moderating images, they're a publisher, so they came after them. So they were trying to actually do the right thing, but that's what got like kind of screwed them on the back end. And then the next kind of evolution was in the late 80s in San Francisco. A woman that had double master's degrees from NYU thought it would be interesting if she could stream strippers online from San Francisco area strip clubs because that would be a much safer environment for them. It was like called Babes for You, and that's actually what started the whole like streaming services was because she developed in the late 80s and people eventually like bought the tech for her and from her and everything. There was an interesting note, by the way, with when they were interviewing the Ohio libertarian family that started all these on the BBS. One of the anecdotes is he goes, for you kids out, we use modems, and so for you kids out there, the modems originally sounded like fax machines, like a fax dial tone. And I was like, that is the weirdest
Yeah.
way to describe. Like, if you don't know what a modem sounds like,
You probably don't know what a
like
fax machine sounds like.
Exactly. That one really stood out to me. I had to take a note of it. And then the story takes so many weird turns. It gets even weirder because now we enter Bill Ackman, and you're like, what the hell does Bill Ackman have to do with this story? So apparently, Bill Ackman reads a New York Times article about sex trafficking and revenge porn, and so he calls up the CEO of Mastercard, who's a friend of his, and he's like, "You have to do something about this." And so Mastercard, they hit Pornhub and make them take down like 9 million videos from Pornhub. I
How
mean,
did
it just like
MasterCard do that?
it's gonna get better. So this is where I thought the most interesting piece was, and this is kind of where I'll end it on, is so what has come to pass is basically the regulator of porn is the credit card companies, and nobody knows this. So they start going into all these things. Then it eventually gets like I'm not giving anything away because it eventually gets into like OnlyFans and modern versions of pornography, and it's saying that basically even on OnlyFans the girls are saying they can't use the word period like if they're on their period or they can't talk about period blood because this is one of the like bullet points that the credit card companies don't want to see. So the credit card companies, MasterCard and Visa, don't want us all to know that they're the ones actually regulating the porn industry because of the credit card processing. And so there's no government agency, there's no self-regulation. It all comes down to just Visa and MasterCard are now the regulators, and it's nebulous of what they're trying to avoid. So it can be these random, it's everything from bestiality to using the word period or having any sort of menstruation blood like on a show. Like it's all these random things that all these girls and performers on OnlyFans are constantly trying to figure out what the credit card company is going to ding them for. And so it's just been this perverse kind of feedback loop where now basically the credit card companies are the primary regulator of the pornography industry.
Once again, this is Pirates of Finance, where there's a lot of interesting stuff there. First thing first, when you were talking about the modem, anytime someone talks about a dial-up modem, I can immediately hear in my head the exact sound of a 56K dial-up modem. I don't know why that has been pierced into my brain, and I could never utter how it is, or I couldn't type it out, but it's like, You just know it. It's in there. It's deep psychologically in there, which is a painful screeching sound to have rattling in your brain. It all reminds me though of, I'm going to take this a little bit of a different direction, but I remember years and years and years ago, I was reading about the engineering problems of these large pornography sites, and especially the free ones, because the amount of video that they serve and traffic that they serve eclipses the vast majority of websites out there, right? And how do I phrase this gingerly? People surfing those websites don't have a lot of patience for latency, right? They kind of want what they want immediately. And so it's this really, like, if you were just to take the pornographic aspect out of it, regardless of how you feel about that, and just approach it from an engineering problem, this is like trying to solve the engineering problem at YouTube. Like, these are non-trivial hosting at scale issues. The problem is trying to find engineers that'll do it, that are willing to say they work at a porn site, right? Because of the social stigma related to pornography. And so how much more capital do you have to throw at an engineer to work at, say, YouPorn or whatever it is versus YouTube, right? Someone is, for that, what is the social premium that has to be paid? Now, the good news is most of these websites, I guess, tend to be insanely profitable when they're at scale, so they can afford having to pay a premium. But there's like a sin employee premium to a certain degree to be able to pull people towards an industry that they might have a stigma, telling grandma where they're working.
There's so many directions I could take that in, but that was a great way of putting it. And it was interesting too. If you actually listen to the Hot Money podcast, they go into like the history of all the people involved and how largely it's been European based and how everything's kind of moved to Prague these days. And maybe there's regulatory reasons for why that's the case. It started a lot of France and Belgium, moved to Germany. Now a lot of it's coming out of Prague, about like a small industrial warehouses in Prague. So once again, like you're saying, it's. But then they're using the technology too to limit the amount of employees, which is kind of an interesting angle as well. They also go into like the whole OnlyFans debacle when they tried to take pornography off of OnlyFans for like a week, and how that worked out and everything. And once again, it was a credit card processing issue. And what's been also an interesting anecdote is like the ones that are starting to take over the space, they run their own like credit card processing companies, and then that's a go-between for then the actual credit card company, and they can like push the blame onto those intermediaries. So it was an interesting angle as well. So we'll change up this topic. But one of the other ones, it was a couple of podcasts. You did a great one with Antti Illiman. He was on a couple other podcasts. And then I was also listening to some Rob Carver on Top Traders Unplugged. But there's like, it's two ideas, but I'm going to merge them kind of together. Rob Carver was talking about the optimal leverage on right skew assets. And whether you're combining left skew and right skew assets, maybe instead of using portfolio leverage, you should be leveraging the right skew assets higher than you'd be leveraging left skew if we were thinking about Kelly optimal leverage. So I thought that was one interesting piece that we can discuss. And then the one that I know is going to make your head explode, so I'm really excited for this. It was Antti Illiman was talking about, when he's talking about commodities and rebalancing commodities, he's like, if you just had a broad basket of commodities and you just equal weighted them and rebalance frequently, you would get that diversification premium from rebalancing just buy and hold commodities.
Yeah. Okay. First of all, I like the hard left turn you took here. This was turning into season 3, episode 1, the pornography episode, and took a hard left turn. So thank you for saving the episode back to finance, because this is the Pirates of Finance. So yeah, so let's talk about, this Rob Carver idea. It's really somewhat near and dear to my heart. A lot of what I have been talking about for the last several months, and this, Jason, I know this is something you've been working on for years, is incorporating leverage into your process. People often think of leverage as being something that's intrinsically dangerous because it creates a knockout condition, right? You get that margin call and you sort of lose everything. People think of leverage as increasing portfolio volatility. When you look at every major financial crisis in the history of the world, typically leverage is involved. Not just financial crisis, like really any crisis that involves money in any way, whether it's a business or whether it's in markets, typically leverage is involved. My caveat there is it's not just leverage, it tends to be concentrated leverage, right? You're using leverage to double and triple down on a bet versus using leverage to introduce diversification. And all of this is sort of very
And leverage on short vol
mathematically.
trades. Yeah.
Yes. Yeah. All this, and so all this is very mathematically sort of modelable easily, naively, when you make naive modeling assumptions like returns are normally distributed and there's no fat tails and everything is what we call IID. And so the returns are sort of every day independent from the previous day. In practice, that isn't true. There's all sorts of agent problems that occur in markets that create conditionality, that create fat tails. Assets aren't symmetric to the upside and the downside, but they often exhibit some sort of skewness. And so when people lever up assets that have a big fat left tail, right? They sort of on average make money and then every once in a while lose a ton of money. They tend to blow up. And so Rob's idea being, well, maybe you don't lever up the stuff that blows up. Maybe you lever up the stuff that actually loses money on average and then makes a whole lot of money every once in a while. Things like trend following, for example, or you could say something like buying call options potentially, where you're deep out of the money call options or deep out of the money put options that you're losing money most of the time, but then when you win really big. And so I think it's an interesting nuance into the practical application of applying leverage. It's not just is leverage good or bad, it's where do we selectively apply leverage to maximize its portfolio impact without potentially creating portfolio ruin.
Yeah, we've been looking at it for a long time now, and philosophically, the idea is a lot of times, if you're combining things that would fall under short vol trades combined with long vol trades, is you actually at the portfolio level only want like 40% in short vol trades due to the huge left tail and that left skew, where you want closer to 60% on the long vol trades. I mean, this is not mathematically perfect, but when you start looking at histories of asset classes, that's when it starts to make sense, that combo. But people, tend to actually skew more towards having predominant parts of our portfolio in left skew assets. And this is why they can generally lead to blow up. But then part of that is, and then so sometimes, when we talked about portfolio construction often, is people combine these different assets or asset classes or different types of return profile, and then they create leverage at the portfolio level. So it's like you can either combine either less exposure to short vol assets, and then you can combine at the portfolio level and add a little bit of implicit leverage there, especially if you're using the 1256 contracts of futures and options. But I think it's a much more interesting, nuanced approach. It also leads to more difficulty. But the idea is maybe you use the leverage differently throughout the portfolio on the right skew versus the left skew assets. And I wonder if you're thinking through that, has it changed the way you think about portfolio construction? And then how do you figure out different Kelly optimal kind of leverage effects on different parts of your portfolio? And then what is the emergent property of them combined?
Yeah, so we dove in deep pretty quickly here. So I just want to take a step back and just like really lay out a really basic example of sort of maybe what we're talking about, right? So let's say I had a 60-40 portfolio and I want to layer on top managed futures, right? So from a modeling perspective, I could say I'm long 60% stocks, long 40% bonds, long 60% managed futures, and short 60% some assumed funding rate. Maybe it's short-term US treasuries, right? And that's how you might model it just on paper. In practice, the question becomes, well, where am I actually achieving that leverage, right? Am I actually buying S&P futures, buying cash bonds, and then taking cash and allocating it to a managed futures manager? Am I buying S&P 500 stocks, buying treasury futures, and giving some cash to that managed futures allocator? Am I borrowing and giving cash to that managed futures manager? Or am I implementing managed futures entirely on its own, using my capital as collateral for those futures contracts, depending on how capital efficient you want to be? All of those in theory are the same, right? You're getting 60-40, 60 minus some funding rate. In practice, though, they're all very different. They have different collateral requirements. They're operationally very different. And the asset in which you're going to be levering up and having margin calls on, right, is going to behave differently, right? The amount of leverage you might be able to achieve easily in Treasury futures might be very different than the S&P 500, which is going to exhibit a negative left tail versus managed futures, which is a right tail. And so I think this is where like the nuances of like empirical finance research really, when you become a practitioner, you start to say, okay, but how am I actually going to implement this, and what are the implementation considerations that I need to think about? Because when the shit hits the fan, I'm gonna have to start wiring money to meet margin calls, right? Like that's gonna have a profound impact on portfolio performance.
Well, yeah, now you're starting to get in the nitty gritty of what we can actually put in a portfolio given the regulatory environment we're in. And then are you able to cross margin that? What happens if margins double or triple in a drawdown? You know, do you have cash on hand? Are the right skew assets actually paying off that you could source liquidity from them to pay for the left skew assets and the increased margin and drawdown? And so that getting into that, it's like that's deep into the weeds of what we both do. But I also think what's interesting, why I wanted to highlight it is like, you know, maybe this is incredibly solipsistic, but like to us, this is like the current state of play, and to me, the future of portfolio construction is thinking about the individual components, what it looks like in the emergent property of combining them, and maybe what does it look like leveraging or deleveraging different asset class return drivers within a portfolio. But also, I'm not going to let you hide from the second part of my question, which was in the interviews like you did and others with Antti Ilmanen. He was talking about, you know, we started talking about commodities and the value of commodities, but you talked about trend following managed futures. But what he did bring up is if you have all these different commodity, you know, uncorrelated returns that are maybe, you know, they actually have, let's say, a 0% return, but have high volatility to the individual instruments, that combining them and rebalancing frequently derives a diversification premium. I'm purposely not saying rebalancing premium because I don't want you to get too angry. But I'm just curious of what your initial thoughts were on that.
Yeah, so for those who don't know who Antti is, Antti Ilmanen is an absolutely amazing researcher in the field of quantitative finance. He's written some really foundational papers as well as books. His most famous book being one called Expected Returns, which I think is very much considered to be maybe one of the Bibles for most sort of systematic style premia investors. Really paved the way in the 2010s for the adoption of a lot of those systematic styles among institutions. He works at AQR with Cliff Asness and many other fantastic researchers and leads up their portfolio solutions group. So he spends a lot of time thinking about how these individual sort of styles fit in a bigger portfolio construct. He had an interview with our good friend Adam Butler at Resolve Asset Management, and they just sort of talked about the fact that when you take a lot of commodity futures and you diversify them appropriately and you keep rebalancing, you can take assets that had a zero expected return and create a return stream that has a positive expected return. And I just kind of have to call bullshit on this. This is one of those things that everyone points to Shannon's demon and says you take two uncorrelated assets and you start just diversifying and you can create a positive return stream. And it just doesn't work that way. The only way that rebalancing can create a positive excess return is if the assets you're rebalancing exhibit mean reversion over the horizon in which you are rebalancing them. That is it. Full stop. There is no, what's the word I want to use? There's no premium that comes from the action of rebalancing, right? Now, what is happening? The reason you keep calling it a diversification premium, well, when you think about constructing a portfolio, there are compound annualized returns, right? There's your arithmetic return and there's your geometric return. Your geometric return is what's coming from the compounding of returns over time. And so everyone listening probably knows the sort of math of losses. You lose 50% of your money, you need to gain 100% to get back to break even. You know, so if I have a year where I lose 50% and a year where I gain 50%, my arithmetic return is actually 25%, right? 50 averaged with 100, but my geometric return is 0. a big influencer of geometric return is volatility. So what happens when you take a whole bunch of assets and you build a well-diversified portfolio is you can lower the volatility without necessarily lowering the expected return. And so the compound annualized growth rate is higher. And so I consider that to be a diversification premium, potentially. But the benefit isn't actually coming from the explicit action of rebalancing. The benefit is coming from the fact you're maintaining a maximally diversified portfolio over time, thereby maximizing your compound annualized growth rate. This is where I'm going to stop because that was, I'm sure, just a bunch of word salad to a lot of people that I seem overly passionate about and kind of angry that people would dare say there's a rebalancing premium. But it's just one of those things that, I don't know. I've fought with Adam about it a number of times, and I think he and I ultimately agree and just disagree on the wording.
No, that's what I think it is. That's why it makes me smile to just to get you always worked up on this because I think you are right. But your issue is you're taking umbrage with the word premia or premium, and you're technically absolutely right. There is no premium or premium there. But then you are correct in that what we're really talking about is proper diversification at a portfolio level. It almost also forces you into a quarter or half Kelly even position sizing over time, which is increasing or trying to close that delta or that gap between the compound and arithmetic return. And that's just smart portfolio construction. Your point is without the portfolio construction diversification, there is no premium there for you to harvest. It's just
Right.
it's just the right thing to do from a portfolio level.
And by the way, I think there's some low-hanging fruit here for product sponsors where if you look at the existing commodity space, most of it is liquidity weighted, right? Because product sponsors are really interested in raising a lot of money. And so to shove a whole lot of capital into the commodity future space, you typically end up overweighting the most liquid contracts, which ends up putting you massively into the energy and away from, like, I don't know, the agricultural, the softs. You know, maybe you get a lot of precious metals too. Versus if you were to say, I'm going to approach this from a capacity constrained perspective and build a product that maximally diversifies myself across commodities, believing that none of the commodities have a positive expected return. So there's zero benefit in going the most liquid other than minimizing transaction costs and being able to shove as much capital into the fund as possible. But on the other hand, saying I just want maximal diversification, which won't sacrifice expected returns because I think the expected returns are zero anyway, you end up with a better compound growth rate. And so I think there's a real interesting opportunity for someone to come out and say, I've come up with a different commodity index. It will likely be capacity constrained to a certain degree, but this is a much better commodity product than the traditional liquidity weighted indices that are out there.
Yeah, assuming mean reversion, you're essentially like just forcing yourself into good behaviors of scale trading, of buying low and selling high in incremental quantities and diversifying and rebalancing. Like that's
Yeah, but assuming mean reversion is a big one because on the other hand, if
Yeah,
you
of
don't have
course,
mean
yeah.
reversion, if you have autocorrelation, you're just scaling into consistently losing positions, right? And so like
And
even if the market
autocorrelation
goes,
for those listening is it?
yeah, go
I
ahead.
was gonna say autocorrelation is a fancy word quants like to use for trend.
Yes. When in doubt, never use a penny word when a dollar word will do.
Exactly. I want to I actually add some interesting questions for you that I was thinking about from portfolio construction and actually launching funds. But I wanted to take a little bit of detour into crypto because crypto has been unsexy lately. But I did see some interesting kind of things I wanted to highlight from different parts of whether it's YouTube, podcasts, papers, etc. Is that the Bitcoin narrative, how it always changes, right? Whether it's a store of value, whether it's digital gold. We joked about it on a previous episode. It front ran inflation, as some would like to say. But the most interesting one lately, too, I've heard now is it's a proxy for CDS on sovereigns, and I think this maybe came out of Foss, the Canadian. Maybe is it Greg Foss? I think that maybe he came up with this, but I'm like, this is the narrative change now that this is a cheap form of buying CDS on sovereigns, and I don't understand where the cheap form comes from if you can have massive drawdowns. the idea of of CDS is like you pay, tiny bips for a large convex payout. I mean, what do you what do you make of this idea of a proxy CDS on sovereigns?
Well, it's really only a proxy CDS on sovereigns under the assumption that the Bitcoin network continues to have value when sovereigns disappear, right? There's a big conditional to that. I think it's much more likely that gold, right, would be ultimately a better. Oh boy, I'm going to piss off a lot of people. I'm going to say gold would likely be a better hedge against sovereigns. It's been the default currency for millennia, right? So I would sort of suspect that like you can go anywhere in the world with a gold chain, a gold watch, and trade it for something valuable because it still retains its value everywhere. And I would suspect that post collapse of any sovereign nation, yes, it would continue to retain its value. It's worth pointing out though that like in a world where there is global mobility, right? You really need to be talking about like the failure of the largest sovereign nations in the world to have a cascading effect to knock into failure of smaller sovereign nations. Like when people used to talk about Bitcoin being as an inflation hedge, it was sort of like an inflation hedge to whose inflation, right? If you are living in Zimbabwe and there's hyperinflation and you can buy Bitcoin that's sort of relatively stable to your hyperinflation, yeah, that's a great hedge. But when you're living in a developed country where there isn't hyperinflation, the volatility of Bitcoin is not a great hedge necessarily against your sort of run of the mill inflation. So it's an interesting question of like inflation with what relative to where, right? I think that local aspect of it is an important consideration in the narrative. But I do find it fascinating. Like Bitcoin continually reinvents itself from a narrative perspective to make itself try to be relevant, which I think is both a pro and a con. It sort of like continually weakens the true use case, but continually strengthens, in my opinion, like if the network continually keeps making up reasons why it has to exist, it's sort of, and I hate to use the word Lindy, but it sort of like takes on this Lindy nature where it's like, yeah, it has value because people believe it has value, and that's why it has value. Like that's it. We all just a bunch of people agreed they would accept it, and as long as they were agreeing they will accept it for fiat, it will continue to have relative value.
Yeah, it's been an amazingly robust narrative change, at least over time. And then along those lines on crypto was Jason Calcanis was on Odd Lots last week or the week before. And the one thing he brought up, I thought you found interesting. He called it it's lawsuit season for crypto.
Yeah,
And so he's
he
like,
went
everybody's
hard,
going to be
right?
starting to. Yeah, I mean, he's always been pretty hard on a lot of crypto and saying it's fraud. I mean, outside of maybe like a few of the blue chips like Bitcoin, Ethereum, he thinks it's primarily fraud, and he thinks they're primarily securities, which you and I have talked about many times. Is they are securities. But yeah, he's calling it lawsuit season, and then at that same time, around that same time, we see that the OpenSea employee that was using insider information and insider trading to front run, he's allegedly getting hit with 40 years in prison for that. We'll see, what actually manifests out of that. But I'll let you kind of touch on both of those points.
Yeah, the Jason point. I mean, look, I think how do I want to phrase this? It's always an interesting narrative shift when it's a bear market and suddenly everyone's willing to come out and go on podcasts and shit all over things, right? It tells you about the state of the market from a sentiment perspective. That said, I think it's kind of bullshit that Jason has a podcast every week with Shamath, who is just like the SPAC king who dumped all over retail with these complete. I mean, they're not frauds, but I feel like there's some need to be investigated there as to whether what was written in the prospectus for these SPACs was even at all reasonable for the potential businesses that were ended up being launched. And he's never called him out for the behavior that Shamath had. Versus now he's coming on another podcast and shitting all over crypto when to me it is the same thing in many ways. So in fact, I would actually argue in some cases with crypto, it's more naive because at least a lot of the Ponzi's I see and have dealt with in crypto tend to be created by people that are naive. Like they thought the tokenomics would work and it blew up in their face rather than explicitly knowing it's a Ponzi and are trying to take advantage of people. Now, some of them certainly are scams, but yeah, I don't know. I find it sort of a little bit tone deaf for Jason to do that.
But at the same time, do you think that I just wonder in the future, like we try to be objective as possible with each other, especially. It's like, do you expect me to call you out for something on a podcast when you're kind of sitting right next to me and that's his homeboy? Like it's.
I mean, I
I mean,
hope
I
to.
hope so, and I hope you
Yeah,
do for me. But like,
I
yeah.
think so. Look, I hope you stab me in the back if I do something like that. I don't know. Like we got to hold each other accountable.
Part of it, by the way, because like we talk about, this is finance, but like by the way, I'm, talking about these different things like the hot money podcast or crypto, whatever we talk about. It was interesting. I was recording a podcast like 2 days ago with a friend of mine, Drew Knowles, that's a rancher, and he comes from a finance family as well. And we were talking about is like essentially all entrepreneurism, business, all this stuff is all trades, right? It's discretion on global macro trades. We are still trading and it's still finance no matter what we talk about. So along those lines, did you see like the economics, you brought up Chamath, like the economics of his Warriors trade, the Golden State Warriors? Do you have any idea?
No, no,
So
I
man,
missed it.
he got the rich just get richer. So I mean, and so he bought, I believe it was 2010, 2011-ish when the Warriors were acquired and when they were one of the worst teams in the league, right? And so he got in on a minority ownership on the deal, and I want to say he bought like 10% of the Warriors for 25 million. Now I might not have the numbers absolutely perfect. This is directionally correct though. And then they go on, they go on an 8-year, 4 championship run. They build a new stadium in downtown San Francisco, everything. Allegedly, the Warriors are valued at like 5.6 billion now. So he sold his stake for $500 million. He sold it for half a billion. So from 25 million to half a billion within like 10, 11 years. And then it gets better. What's more interesting to me too is it looks like the people that bought it are Arctos. I think is what ARCTOS, I believe, is their firm. Who's been talking a lot about him? It was capital allocators. Ted Seides was always, I think, involved in the beginnings of Arctos, and the idea for the Arctos was that these sports franchises are great assets to own, but they wanted minority stakes, so they started up funds to buy minority stakes in these firms. So everybody was talking about Chamath, and I was like more interested in like, man, Arctos has really raised some capital if they were able to pay him 500 million for like 10% of the Warriors.
Yeah, that's super super interesting. I mean, look, you sort of say the rich get richer. Yeah, it's a gamble to put
He took risk, though.
$25 million.
It took
Yeah,
risk.
I mean,
Yeah.
look, there's a bunch of things that have to go right, right? The team you pick, ideally, you're buying an undervalued asset. It needs to be managed well, right? They need to win championships. You need to grow the value of the franchise. There's tons of reinvestment that needs to happen in players and arenas and creating the fan base, and you need the sport to maintain popularity. Now, you might say, well, hey Corey, it's the NBA. The NBA is not going to lose popularity, but you've certainly seen like a decline in popularity in Major League Baseball, for example. And these franchise and these sports leagues are constantly changing rules to try to maintain and maximize popularity with fans. So I'm not sure. I think, look, obviously 25 million is a lot to put up, but if you just had 25 million back then, was that an obvious trade? I'm not sure it was.
No.
I mean, the Golden
They were the
State
worst team in the
Warriors
league, yeah.
were right, and so you might say, okay, super undervalued, and they'll just get dragged up as basketball does well. But like teams can languish for a long time, right? There's nothing that's like when you're a bad team, it can have pro-cyclical effects because it can be hard to attract talent, right? So you have to figure out a way to break out of that where your fan base is deteriorating, you're not bringing in as much money, right? You can't acquire the right type of talent. You stay the worst team in the league, right? That's a risky trade. That's got some really nasty pro-cyclical aspects to it that can keep it in a downward spiral. So, yeah, I mean, brilliant trade in hindsight. It might have been a horrible trade, ex ante.
Yeah, or like your point is, I think if it was 2010, 2011, you're coming out of the '08 crisis, right? And the team's in Oakland. So you're also looking at like this is a bet on Oakland. Like it's probably, yeah. In hindsight, we look at the trade to make sense, but like I can imagine 2010, 2011 coming out of global recession, betting on Oakland probably didn't make a lot of sense at the time. But the other thing that I did want to bring up that J. Cal talked about on Odd Lots to get your take, even though this isn't necessarily something you and I talk about that often, at least publicly, is he said, as we've seen historically, recessions are the perfect time for startups. That the real grinder startups are usually launched in the middle of recession, whether that's 2000 to 2002, 2008 to 2010. Do you think like this is the weirdest recession I've felt in my life, which is not that long, but like it doesn't feel like the opportunities are abounding right now. It doesn't feel like there's that much pain as we would expect kind of in the markets where you could really pick up deals. Or is this a time where you're thinking about, that VC has been overly frothy, so maybe this is a time for allocating a small position in your portfolio to VC and kind of starting to leg into those over the next year or so?
I mean, I don't know how you feel. I feel like I haven't seen a tremendous amount of markdown yet. You haven't seen it in private credit, private equity, private real estate. Nothing's on fire sale. You've had a slow grind lower in equities, right? And fixed income, right? Equities were up until a week ago, call it 15 to 20% off their all-time high, but that's a pretty normal pullback, right? That's supposed to happen every year or two. That's not bear market pain. That's not a recession. So it might be a very shallow recession or a real recession, but not a nominal recession where there's an expectation that inflation is going to sort of disappear shortly. So I'm not seeing pain. You're starting to see markdown in real estate prices and asks. You're starting to see some markdowns in just things in general, right? I think the term stuff session has been sort of floated, where you were talking about that bullwhip effect. 18 months ago, it's in full effect now. I mean, I know people who are looking to buy cars that everything was going well over ask a year ago. Now they're getting all sorts of deals thrown at them to buy cars. And so I think there's an opportunity if you're interested in acquiring things, that things will probably start getting pretty cheap, weirdly enough. There's going to be a deflationary aspect for some discretionary goods probably this fall. But I'm not sure from like an investment asset perspective, there's any screaming buys out there right now.
I want to kind of jump ahead to another idea that to me is like right in your wheelhouse of things I would want to discuss with you that I think you would have interesting insights on, and that is this idea of like I just noticed recently like the night shares ETF came out, and this is no shade on night shares ETF or anything. I haven't dug into the mechanics, neither have you. Like it's just something interesting to look into. But I've seen how the marketing's come around night shares, and the idea is that the overnight effect. Buying at the close. I mean, yeah, buying at the close, selling at the open, and what we've seen historically over the last decade or so, on how that's a great strategy. But what's interesting to me is this is why I think it's perfect for you. Is like I've always wondered when you start taking this CRISP data, this University of Chicago data, and everybody's starting to torture and manipulate this data. You find out you have all these like spurious correlations, and especially if the data is not long run as far as clean data, you start looking at the most recent performance of, let's say, the last decade, and you start to see this overnight effect. But then, as you and I both know, you can find a lot of effects. But then, if you start bringing in transaction costs, slippage, et cetera, those tend to erode away quickly over time. So it's not necessarily pointing out one specific philosophy. What I'm more interested in, from your perspective, is how, if you look at something starting to really accumulate over the last decade, that's a spurious look into a backtest. And to me, once these products start getting launched, because now they have the actual data set to show you it works, is that just peak for this type of trading, and it's usually downward from there. And we've seen this time and time again when people manipulate CRISP data. It looks great in a backtest, and then as soon as they start implementing products in size, it just goes. It's right at the peak performance, and it just is like asymptotically downhill from there.
There's actually a whole academic study about this effect with ETF launches. That pre-launch,
All right.
how does the backtest do, and then post-launch, how does the backtest do? And I do think, right, when you think about what does it take to actually launch a fund, right? At minimum, there's a 90-day filing process, right? So if you had the idea and all the capital and were registered with the SEC and were able to find a fund administrator, fund accountant, legal, compliance, got everything filed, you could get something out the door in 90 days. Realistically, it's, unless you're an existing firm, it's 6 months. If you're a new firm, it might be a year. right? So I think what ends up happening is you get all this, people notice something in the data, they start talking about it more and more. The fever for the product builds, someone decides to launch the product, there's a delay in launch, and it's just sort of perfectly coincides with, okay, this was not a real effect. The overnight effect is really interesting in that there's a ton of potential explanations for it, right? You and I both know some people in the volatility space who argue that this overnight effect where the S&P 500 tends to accumulate all of its upward value when the market's closed, sort of the close to open, and then open to close, the cash market ends up being negative or flat over time. People have argued that that comes from hedging pressures, overnight hedging pressures. People have argued that it's a valid liquidity premium, that you're willing to lock up capital overnight and take on illiquidity risk. People have argued it comes from being willing to take event and news risk tied to the illiquidity premium, but all the earnings are announced after market. So of course there's a repricing, and there tends to be an upward drift with a lot of that because you're taking event risk. You should be compensated for it. So on the one hand, there's some rational risk premia arguments as to why you should be compensated for holding overnight. But to your point, if it were just that simple, right, and it existed net of costs, then why wouldn't everyone do it, right? And it has been incredibly persistent, and our good friend Wes Gray over at Alpha Architect has published a couple pieces where he's looked into the literature that suggests, yes, this is a incredibly robust phenomenon historically, but good luck trying to implement it, because the second you try to implement it, slippage and transaction costs eat away at all of the premium. Because, by the way, you're having to trade every single day.
Right. I mean, how many strategies have we found that looked fantastic till we got into trading costs and slippage, especially when you start talking about the VIX complex. So that's always been the bane of my existence. But to give a very specific shout out on it, like you said, it's on the Alpha Architects blog, but it was a guest blog post by Matthew Bartolini from State Street that really talked about the overnight effect and really that cost. And like you referenced, is how much of it is just earnings season, right? Because earnings get announced after the close or before the open. And I think that was like 60 to 70% of it. But it was interesting. Like, it had phenomenal returns until you factored in the transaction costs. And then, I work with firms like, just to talk about, no investment advice and bias, is like Deep Field out of Switzerland. The way they deal with like overnight effects is by trading the Asian and European markets, which is a bit different because you get that liquidity there, and you trade those like heterogeneously. It's a way to maybe try to capture what's going on in the overnight markets in the U.S. So that's just another way of looking at it. But once again, it's a proxy and basis risk, so it's not equivalent to the overnight markets. So yeah, it's tough. Like, I think you were nailing it with liquidity, and people don't realize how much liquidity affects any individual strategy, whether you're trying to trade small size or large size. It's still affect that. Even if you think you're a minnow in the space, liquidity can dramatically affect you in interesting ways. The other one I talked about, I don't think you there was part of it is that's what it was much more philosophical though. Like, do you think then when you look for strategies, are you almost trying to find strategies that don't look good in a back test? Like, this is really like, bear with me for a second. It's like, if you can create a great back test with crisp data, like, that anomaly is about to go away, even if it does exist. And so really the money is made in trading, for having a divergent view. And so almost you have to look for strategies that you think will work, but you can't actually put together the back test that would show it would work, or else it'd be arbed away.
Yeah, so I think for the low-hanging fruit, and I consider sort of intermediate term equity signal type stuff, put a trade on, hold it for 6 months type factor rotation strategies. For those to work, I think you either need to have a unique data set that no one else has and you have a true intellectual edge, or it's a game of what I would call no pain, no premium. Like, you just have to be able to hold on to the trade in a way that no one else will. And so the back test by definition is going to have to look ugly. It's going to have like 10-year underperformance periods that gets everyone else to capitulate and ultimately sell you their assets at a less than fair value, so that you can then ride the repricing upward when you buy them. And so I just ultimately think for a lot of this stuff, it requires having sort of ugly realized performance from time to time. It's sort of like the only way you can get other people to capitulate and pass you the premium. That's where the zero sum nature of it all comes from. That said, I want to take it a different direction because I'm curious as your thoughts on this. A lot of empirical finance has historically been around making sure that the strategies we find, like the value premium or the size premium, are not false positives, right? Um, and so we tend to look for these high T stats, all these statistical tests that make sure that it's statistically robust, but it's at the cost of potentially throwing away strategies that would work out of sample that just didn't happen to work on the one realized path of history that we experienced. And there's a growing body of literature, and when I talk to practitioners who are implementing the idea of saying, look, when you have a strategy that doesn't work, worst case expected scenarios is just trading costs. And then the rest is random noise. But if you have a strategy that does work, you get trading, alpha minus trading costs. And so it's actually worth allocating to strategies that might be false to make sure that you're potentially allocating to more strategies that could be real. And it's an interesting sort of new way of thinking about balancing sort of type 1 versus type 2 error from a statistical perspective. Just being willing to accept more incorrect false strategies so that you don't miss the ones that don't show up well in the backtest.
Yeah, along those lines, it was actually what you were almost saying, like more previously with that. It makes me think of several things. And one is that, as I talked to a lot of managers, they've had, trading strategies go in and out of style, in and out of vogue over time. Like, as we know, dispersion is a classic example of this. And so, like, if you took that completely off your books, you're going to miss when it comes back. So it's like, do you hold strategies in combination where you get this emergent property where, like, I can hold it through its downtime because I know it's going to maybe come back eventually, and then I'm riding that wave in kind of both directions, especially if I'm rebalancing with other strategies. The other one, and the way I think about it is, as you know, what's the old quant quote is like, a great Sharpe ratio is just showing you where they haven't discovered their left tail yet. And so that's, it's so I think about it in the terms of robustness. So what you're saying is like maybe combining strategies that aren't perfect is like, a shout out to basically managed futures or CTA trend following is like, they always talk about, they run a shitty Sharpe ratio. It's a lot of times, on average, it's probably about, 50 bips, it's a half a point on the Sharpe ratio. And so, but it's a much more robust to drawdowns than it is to volatility. And so sometimes that robustness will actually have survivability because it may not be a Sharpe ratio of 2, 3, or 4, but you can maintain it for decade upon decade without having necessarily liquidity issues or all the other sorts of issues when you'd have a much more optimized strategy.
Right. Yeah, it's that balance. And I feel like so much of at least my evolution in this space has been going from like the pure rigorous statistical quantitative way of approaching this stuff to recognizing there's a lot of discretion and art and trade-offs that have to be made, and not all the answers lie in the data, right? A lot of it lies in just like common sense expectations for portfolio design, for strategy selection, for strategy design that can sometimes make your strategy look worse on a backtest perspective, but far superior out of sample because you recognize there are just events that don't exist in the backtest that you will likely run into over the course of your career.
Well, there was great on SFI Institute has a complexity podcast, and one of the scientists on there was saying like, if it were all obvious and easy, we'd be doing engineering, but we're doing
Right.
science, so that requires a lot of
Yes.
unknown unknowns, and that you have to deal with it as part of it. I want to transition kind of to something. The last thing I want to talk about. So what I what I have realized on this episode is I keep kind of cornering you into using all the Beetlejuice words that will get you into trouble. And so I'm going to go right out on the top though. I noticed before we logged on that you had a tweet about ESG, but I didn't have time to read it as we were logging on. But I wanted to bring up this idea now we have of ESG retaliation, where now a lot of West Virginia voters they have a lot of backlash against certain companies in the government that are trying to go after coal miners. And it's interesting they're aggregating together to try to fight this kind of ESG backlash. So they're actually saying they're not going to use any of their pension funds or institutional funds to like invest in like BlackRock or Blackstone that are pushing ESG mandates. And the other one that related to the ESG kind of retaliation was I was at a private event a few weeks back in Vail, and we had investors from all over the world, and I started asking the Europeans is like, was Ukraine the straw that broke the camel's back with ESG in Europe? And now they started changing all those definitions because they need better energy sources. So I'm just curious, so like if you had a hot take, like I said, I'm just trying to get you in trouble with this sort of ESG
Yeah,
retaliation and these packaged products.
I appreciate that. Thank you. Just throwing me under the bus like a good co-host. What I will talk about, I love that line of thinking, though. Does the Ukraine-Russia energy problem break the back of ESG in Europe, which is way more popular than it is in the U.S.? Like you cannot launch a mandate in Europe without it being ESG. No. Versus the U.S., it's incredibly nascent still, growing in popularity, but relative, just not even comparable. So the tweet that I did was actually, again, Wes Gray over at Alpha Architect. They publish a ton of great summaries of recent research. I think Larry Swedrow had authored this summary for them. And it was about a research piece that was looking at what I would call ESG orphans. That if you were to take all these ESG definitions and apply them to, say, the S&P 500 and find the stocks that are left out, those are the orphans. Those are the ones that'll never get bought. One way, they're the sin stocks. And they back-tested the performance of screening for ESG and picking the orphans and found that both on whether you equal weighted them or value weighted them, so market cap weighted them, it generated excess returns relative to the benchmark that could not be explained by any known existing factor. And the argument was basically ESG has gotten large enough that when you start selecting for ESG, you are arbitrarily pushing up the price of one cohort of stocks and pushing down the price of another cohort of stocks. That makes the price of that second cohort more attractive from an expected return perspective. Because, for example, at the very least, you could see that the dividend yield, for example, might go higher, or there might be a higher buyback yield. Different ways in which capital can be deployed to shareholders. And so the argument was that indeed this flow of capital is potentially creating an irrational characteristic and factor within the market, that you might actually be able to generate excess returns if you buy sin stocks because ESG is now so popular. What I tweeted was that Cliff Asness at AQR, who we talked about a little while ago, actually wrote a piece in 2017 arguing this from a theoretical perspective, basically saying you can't just everyone decide to buy ESG stocks and beat the market, which has sort of been like a little bit of an attempt. What's happened is people have tried to say, oh, actually ESG is higher quality and quality is rewarded. His argument was if the whole market floods to ESG, they're going to be overvalued. By definition, the way expected returns work, that should make that cohort of stocks unattractive, and people who are willing to buy sin should outperform. And it was interesting to sort of see an out-of-sample 5-year later test that showed it in the data that the orphans, the ESG orphans, or the sin stocks, actually did seem to exhibit that excess return. Now, last thing I will say is this sort of also flies in the face, though, of the idea that flows are pushing up value and price, right? Because you have this one narrative that passive flows into the market are driving prices irrationally upwards, and that stuff that's included in a popular index tends to be pushed up more than stuff that's not included in an index. And this is saying almost the exact opposite. There was so much flow into ESG that it made the sin stocks relatively attractive and have higher expected returns, and there was actually a premium from going against the crowd. So just in the general zeitgeist of what people are talking about, I thought it was a really interesting paper. That all said, last caveat, I have not dug into the data. I can't say whether this is like a well-done, peer-reviewed paper or not. Worth exploring more, but I just thought it was pretty fascinating.
Yeah, along those lines of what you're saying, from the pushing down, but also on the pushing up, I think like Vincent Deluard and others have shown how a lot of ESG just automatically aggregates to tech companies because they have fewer employees. So the outperformance that people thought they were getting is actually just because they're heavier in tech over the last like 5 years.
Right.
And I wanted to wrap up, but actually before we do, just because I want to push this boundary of like what is finance, right? And we're talking about every asset class in the world. We also find business and entrepreneurship as trading as well and part of finance. And so Nelson Peltz was on David Rubenstein's like Bloomberg chats, and I just wanted to pull two pieces out there that I thought were interesting. Was that he said, you know, they were looking at PE firms and like Q1 of this year, and one of the PE firms was up 2.8%. Meanwhile, the market was getting killed, and he's like, how does that make sense at all? Like this charade can't go on forever. But what he was saying though is this like turtles all the way down is like the allocators actually love this charade, right? Because if their publicly traded index or stocks are down and their allocation is up, the mark to model on that book, it looks like they're doing an unbelievable job. So like everybody's kind of in on the charade, which I thought was a great way of putting it. And then I just love at the end, it was like, I think, David asked Nelson, like, what's the best like investment advice you ever got? And he pulled up a mug that has his was it Train or Tryon Partners on it. And the quote is, he said I think said he got it from his dad, but the quote was, sales up, expenses down. That's the best advice he's ever gotten. And I was like, that's just so perfect for like just everything in life. Like we try to make this all complex. You and I use these big words and everything, but it really is sales up, expenses down.
Well, maybe that's the perfect point to end it. That'll be the episode title. Sales up, expenses down. Well, buddy, this has been fun.
It's great to see your face.
Yeah, Return of the Pirates season 3, and hopefully it'll just never be a season 4. We'll just keep going forever.
Yeah, and by the way, and just say it again, shout out to Blockworks. We really enjoyed our time there. We just wanted to be back on our own channel because we're pirates and we can't help ourselves. But we look forward. We should be publishing these every Friday on the Pirates of Finance YouTube channel, but also we'll be publishing the audio as well. So please, if you prefer audio, please go and listen to the podcast. And as Corey likes to say from his Flirting with Models, rate, subscribe, like, do all those things because it helps the algorithm. Do you have I just mumbled that. How do you even say it? What's your rate and subscribe? Go to Apple Tunes store and give you 5 stars and write.
I don't think it's, buddy. I don't think it's called Apple Tunes. What is Apple Tunes?
Did I say Apple Tunes from the Apple Store? I'm losing it.
Yeah, listen. Listen, in the world of social media, you got to exploit the algorithm. So you gotta give it the thumbs up. You got to subscribe. You got to like. You got to watch. You got to comment. You got to interact. Helps us out tremendously. So we greatly appreciate it. If you want to see more of the content, do any and all of those things, and it'll help us out a great deal. So anyway, thank you everyone for tuning in. We'll see you next week.
Actually, I'm analog. We should have people write notes and slip them to people at coffee shops that they subscribe to us. See everybody next week.